Hello, everyone. Those who are here, some others are going to be joining. The topic today is very important. It's already in some spaces of advocacy. We're finally talking about the debt in the North, something that seemed to be something that was just about the developing economies, and now it has been developing in the developed economies. So it's a central topic within the policymakers in the northern economies. And in that sense, we developed this webinar called the Debt of the North, a, a contested financial order, global imbalances, China's rise. And remember, we do have the interpretation here. You can find the button in the below the screen. Um, and well, before anything, I do want to present our panelists. First, we have Dr. Ugarteche, who's joining us from the Institute of Economic Researches of UNAM in Mexico. We have Ariela Riscado, who is a research economist from the Centers of Development Promotion, ESCO in Peru, and Dr. Yang Ling from Wilmette University, and she's a social academic non-resident of Boston University of the Global Development Policy Center. I want to remind you that by the end, we're going to have a Q&A. So therefore, if throughout the presentations you have any questions, you can place them in the Q&A box, or when we have the Q&A session, you can take the word. So to give you a context, we have to understand that we're living in a world that is having very deep tensions in the economic world order that is marked by a war state that hardens the financial conditions, pressure in prices, and reconfigures relationships between the different actors. This, of course, is going to affect directly the global south, but also it translates to the advanced economies. Now, in the particular case of the US, the debt dynamic that is added to the role as the global currency issuer has made it reorganize their deficits, both fiscal, commercial, and that is something that the current governments are concerned about. So this dynamic clearly is sustained by the privileged position that the U.S. has, which is the only actor that can finance persistent deficits with exceptional conditions, which was called before the exorbitant privilege, the capacity of issuing debt against themselves. And well, the power of the bonds in the US as a reserve asset, that apparently this dynamic is starting to change. Also analyzing the role of China, the rise, which induces to that question regarding the capacity of the economy to get established in the middle of the international financial order, without recurring to the same issues that the US have been having. That was called the Griffin dilemma. Since they issued the global currency, they have to assume those deficits. So in that context, and say in the understanding that these power struggles, these global imbalances affect directly Latin America. To not take more of your time, I'm going to let our first panelist speak, Dr. Oscar Ugarteche, with the following question. How has the international financial architecture been transformed facing the increase of the public debt in advanced economies and the persistence of dollar hegemony? Thank you. Hello. You can present in Spanish. We do have interpretation into English. I think that most of the audience speak Spanish. So, so before landing in how the architecture has changed, I want us to talk a little bit about how two rules have been created for one world from the comprehensive, which has brought global imbalances. Um, so here we have an element that I would like to bring to the table, which is the concept of highly indebted rich country. So far, the concept has been poor country, highly indebted. But what we are seeing with the US, with the UK, with Italy, with Japan, is that the levels of debt are 100% of GDP with no solution outside, with a payment of interest equivalent to the higher expenses in the budget. They're spending more in paying those interests than education and health. Many of these countries have gotten to that situation through the reduction of taxes, maintaining a high public expense, and many are free of risk assessments because they're trusting their currency in the euro, in Italy, in the yen, in Japan, and in the dollar in the US and pound in the UK. We are in in an abnormal situation where the bigger debtors in the world, who are Japan, UK, Italy, US, and France, are bringing conditions for the creditors. And that happens in the G20. And that goes against the rule that the one paying, the musician is paying for the song, right? Which is applied in the FMI or IMF and everywhere. So there's a rule for the highly indebted rich countries and different rules for the poor ones that might not be highly indebted or those who are. I want us to start by talking about what has happened with the innovation. Because in order to have imbalances, the imbalance is coming from somewhere. And I decided to enter into this through the technology side. So in 2024, this 70% of the patents were coming from Asia, 17% from the US or North America, and 9% from Europe. The utility models, 98% or 99% are from Asia. If the US doesn't have any. Registered trademarks, 65.3% are from Asia. North America has, I don't know, doesn't say a number, and 17.4 coming from Europe. And in design, 68% is from Asia. This is a database from WIPO, so the World International Patents Office. So in patents, and this is 2024, from the whole 3,725,000 patents that were requested in 2024, 49% were from China, 16% from the US, 8% from Japan, 6% from Korea, and this is showing that the Asian countries, Japan, Korea, and China, have the most part of the new patents. If they have the new patents, they have the new products, and therefore those are the products that are being exported the most. And so there's a lack of competition from the US and from the Occident or the West in general, but US. So when we look at the 10 firms around the world that registered patents in 2024, it shows that it is China, Huawei, is the most important one with 7,000 patents. Samsung from South Korea is following. Qualcomm from the US is following. LG Electronics from Korea, and then some others from China, Sweden, Japan, Germany, Finland. So you have there that there is at least one, two, three Chinese companies. You have two from South Korea and one from Japan. Hmm. So you have six of 10 that are from Asia. And that definitely is going to make it so that those companies that are the ones producing the new things, sell them around the world. Now, we're going to talk a little bit about some basic definitions. So the fiscal deficits and the external deficits are equivalent. That is the basic definition, right? And what connects the external deficits and the fiscal deficits are the public expense that exceeds the fiscal um, income, then the low recollection of taxes, and an open economy and a restricted economy. That is a basic definition. In reality, if you look at the blue line, this is 2000 to 2025. The tax collection in the US has been reduced and has been sustained there. It started in about 20%, a little less, then it went to 15, and then it went up a little bit, and it is lower than where it was in 2000. Doctor, one second, please. I just wanted to point out, Doctor, that you're not actually presenting the slides. We cannot see them. Can you share them? Oh, I apologize. I'm so sorry. Why am I not sharing? Okay, let me see. Give me a second. Oh, you didn't let me know. I mean, you just started describing the graph. We weren't aware. So how do I share this? Oh, share. It's here. I apologize. Yeah, we can see it now. Thank you. So you have the blue curve here, or the blue line. I was like, here you have the initial graphs. So you have here the one about the patents, the first graph, 70% of the patents from Asia, China, Japan and Korea. Together they have most of the patents. And here we have the companies that have been registered. These are the ones. No, no, the fiscal issues. So the US tax revenues here in the blue line, and here in the orange line, we have the public expenditures. So as you can see, the public expenditure is going upwards. So in the beginning, this first peak in the eighth year has to do with the crisis in 2008, right? It was sort of to save the great financial institutions. And then the second one, the second moment is with COVID in 2020. The result is that there is an increasing um, tax deficit, and that is bringing an increase in external deficit. Now, here you have the US fiscal deficit, how it grows, and how it reaches these levels in like 2020, almost 14% of the GDP, but with a trend towards an increasing deficit, like the line is going downwards, and it's very evident. So, what has happened with the fiscal pressure in the US versus its peers, the other rich countries, right? And what has happened? The US is below the average. If the average of the fiscal pressure, the taxes in the OECD countries is 34%, around that. Um, in the US, it's 25%. So they are 8 points below the average and with a trend of going downwards. Here you have the consequence, which is the public debt increasing. In a first moment, when we had that first peak of the public expense in 2008, you have an increase here, an initial one, and then the second one, which is 2020. But then it is sustained. See, here the thing is not if the US applies or doesn't apply counter-cyclical policies. The thing is, if you cannot rebalance your economy after having been through a shock. I'm trying to think about Latin American shocks and what it costed us. When we were exported that dollar crisis in 81, it was a decade for us to come back, but we did go back to original trends. The US, not only have they not been back to the original trend, but they continue, and there are no shock elements beyond the ones that they introduce themselves into the international system, for example, with the oil prices now. And here we have the interest payments in the GDP. So I want you to see that now we are at 3.2%, around that of the GDP for the debt service. That is an important field because it's the higher part of the fiscal deficit. So we are in in a peculiar situation where a rich economy, most of the fiscal deficit are the debt interests and not the public investment, which is what it should be, right? Here you have the interest payments related to the GDP with the fiscal deficit in relation to the GDP, and that is a proportion right there. Um, all of this has been accompanied by a war against China. So if you look at this from the fiscal point of view, the war against China, what it's looking for is to go back to a system of public financement based on foreign trade, which was the rule in the 19th century. But there's other elements in the war against China. We have the patents, the licenses, the foreign direct investment loans, um, visas, restrictions on the sale purchase of goods, trade quotas, import duties, and sectoral tariffs. That is part of the war against China. So the question is, and why against China? What does China have in particular to do with the issue regarding the US fiscal deficit, and in particular to do with the external deficit in the US? And now we are going to look at that. In 1989, after in the US and in the UK they opened their economies, China opened their economy. And it was the US government who went to China and said that they wanted to produce in China. The US government said they wanted to produce in China because the production costs or manufacturing costs are lower. And the Chinese government said, okay, as long as you can train our workforce on the one side, um, we are willing to finance the return of the finished goods over here so they can go back to the US. So the export credits of China start financing the US. And they produce with lower prices. And the logic behind that in 1989 was that if it was good for the companies, that companies were going to be more profitable, and therefore the stock market was going to be more optimistic. They're going to be wealthier, and that would be the solution moving forward to produce in China or to manufacture in China. And they forgot that if they moved the manufacturing to China, they would leave behind the workforce in the US. That is not the responsibility other than of the federal government and the group of advisors that moved around that decision of transforming China into the world manufacturing facility, because that was a decision taken in Washington, not in China. Now, the result, what was it? That the exports or the deficit with China, you have it there, the green line. The deficit with China has grown consistently. Yeah, I don't know what they expected, but I think that that is a natural result I am not manufacturing in my own country. I'm importing. I'm manufacturing in a different country. I'm bringing it from that country because it's less expensive. And furthermore, I'm taxing less at home so that they can consume more. So I have more fiscal deficit, more external deficit, less employment, less industrial activity, and more imbalance. That's it. So how is it that this got translated into a topic of extra US responsibility? That's a little bit hard for me to understand. So what is the new thing with Trump? That they put tariffs into all over the countries. They impose tariffs all over. So they want to fight the fiscal deficit by charging tariffs, right, for their public deficit. The second thing, he renounced all of the trade agreements signed throughout U.S. history. Third, the return to the 19th century system of tariff payments. And fourth, the solution to their fixed file solution, they believe is going to be coming from outside the country. There is no an understanding that the fiscal issue in the US is not going to be resolved externally. The fiscal US issue is going to be resolved inside. It's an internal economy issue. And blaming somebody else does not resolve the technology issues that we have already mentioned. Now, as all of this is happening, what you have is two rules in this game. You have a rule that says that if you have big fiscal deficits and external deficits, you have to adjust the economy to sort of regain a balance. And the risk assessment um, score entities are going to assess the risk and tell you what is the risk of debt internationally. And then and with that, you're sort of going to maintain. That is how the international system is ordered. You may not agree, but that is how it happens. But in the case of the rich economies, and particularly in the US, it doesn't work like that. You have the big deficits and deficits of over 6% of the GDP. They have an issue regarding deficit, not just fiscal, but also external. And they also have a productivity issue. They have a manufacturing issue of technological assets that is way delayed. And it's not being resolved by prohibiting the trade. It's not going to be resolved that way. The restrictions in trade have to do with emerging industries that have to be able to compete to protect the activity. But in this case, there's no emerging activities. What the US is doing is protecting the activities, all of the activities. And this, I think, doesn't really have much of a future. But the international system is not punishing them. What has happened with the international system is that they're losing faith in the treasure bond as a international reserve instrument. So there's two rules where the US can do whatever they want and the rest of the world has to be subjected to a certain discipline. It would seem like now needs to be adjusted in a certain way. The consequences of what has been happening in the last few years is that the presence of the US in the global trade is shrinking, and that we are seeing now a loss of certainty in what has been the epicenter of the global capitalism, with which the US is becoming an unpredictable partner in an important market, but an unpredictable partner. This is sort of the framework in which we have those two roles in the game. And I think that I'm going to leave it there and we can continue conversating. Thank you. Thank you, doctor. So, very interesting how the imbalances in the US are being introduced from the technological side, where you can see that it's just a direct conflict, talking in geopolitical and war terms, but also in technology. So we see how there's a reconfiguration in the world, how these imbalances also have a historical transcendence, and actually how that invite of the US to bring down the multilateral system. They're also doing it in, sort of to try to adapt the system into their new financial conditions. And clearly, data can show how the payment for debt service has increased importantly. Now, to continue with this conversation and understanding that in this game of global trade, if we have a deficit country, we have also a creditor country. So we are going to analyze the role of. So, Jan, I'm going to let you speak about the global imbalances and deficits and those capital surpluses, the global savings, the implications in international liquidity, and how that makes this global south vulnerable. So, the question for Jan, I'm going to say it in Spanish and then in English. So, what is the role of China in the configuration of the global imbalances currently, particularly through their elevated savings rate, external superavits or surpluses, and the accumulation of international assets? And how does this dynamic act in the persistent deficits in the US and the centrality of the dollar?
All right. Well, first of all, thank you so much for inviting me for this webinar. As you just mentioned, this is a really important question. So I'm glad to be here to share my views. So let me first of all share my PowerPoints. All right. So I think Professor Ugatek, sorry for butchering you. I think you did a great job, talking about the technology, the productive side of this imbalances. So I would sort of switch a little bit to talk about the financial and the monetary side of this imbalances, because to me, this is not just a current account, sort of imbalance, right? We oftentimes think about global imbalances as current account is about trade, but I think there is a financial root to these imbalances. So that's what I would like to present to you. So I would talk about, first of all, the current imbalances, and then I would talk about the missing factor that we have not talked enough about what caused these imbalances. Then I will talk about the risk, and then China's counter strategy. And this is about, again, on a more financial aspect, how to navigate through the current global financial order and develop an alternative. And I think that would benefit China, but also for global South countries. So global imbalances are back. So these are the data directly from the IMF external sector analysis. So I highlight the US and China on these two sides of the imbalances. So China is running a current account surplus to about 0.4% of the world GDP, and the United States, represented by this black column, represents about 1% of the GDP, world GDP, right, in the deficit side. And I said this global imbalances come back in the worst form because when you look at the cumulative, when you look at the country's net international investment position, we're seeing the kinds of a cumulative current account deficit in the United States was worse, right, than back in 2008, 2009 financial crisis. Excuse me. So back then in 2008, the US's net investment, international investment position to the world GDP was around 5%. Today, it's 20%. Okay, so the United States, after running decades of current account deficit, the cumulative net liability towards the world now accounts for about 20% of the world GDP. So the US is definitely a very weighty player in accounting for this global imbalances. Now, the mainstream, of course, has been producing a lot of diagnosis of what caused the imbalances. So most of these diagnosis, the analysis, focus on the so-called macroeconomic imbalances, right? So in other words, there are these over savings in the surplus countries like China, Japan, Germany, and others. And then there is the under-saving countries, and those are the ones that run deficit. Okay, and these oversaving and undersavings are driven both by the so-called economic fundamentals, your demographics, your different productivities, and your different financial structures, but they're also a product of policy choices. So the IMF notably point out China's so-called macro industrial policies, which include exchange rate targeting or trying to lower the exchange rate value, undervalue exchange rates. And then its industrial policies, its capital account controls, all of this allow China to run asset savings. So that's account for its surplus in the deficit in the current account. And in terms of the consequences, so I want to just bring out these two quotes. One is by the CEPR, so the Center for Policy Research Center, that talked about persistent deficits can undermine confidence, trigger currency pressure, rising borrowing costs, sudden stops, or debt crises. Financial instability risks tend to be more acute on the deficit side. So, AKA the United States will see more of these negative consequences. But G7 seemed to argue differently. In their study, they said the imbalances pose risks to both deficit and surplus countries in the form of lower productivity growth, trade wars, market volatility, and financial crises. So both deficit countries and surplus countries will face those kinds of consequences, right? So the consequences are definitely undesirable, and therefore they prescribe the different remedies. Now, giving China, Europe, especially Germany, and US account for about 2/3 of the total global imbalances. They focus on what these three countries / economies need to do. So China needs to rein in its industrial policy. It should boost its domestic consumption. And Europe needs to raise public investment and boost productivity. And the US needs to have fiscal consolidation to address savings shortfall. So in other words, the policy choices need to be changed at the individual country level. So what I would argue is missing from all these diagnoses and prescription is the role of the current international monetary and financial system in both generating and perpetuating the imbalances. So in other words, the United States is able to run 4 decades of a current account deficit, has some structural reasons. And again, surplus countries that comes and goes, used to be Japan, and now is China, Germany, and Japan. I think there are structural reasons for why there's always this persistent imbalances, which I think J. Maynard Keynes, right, back in the 1940s, when designing the international monetary system, has already warned the danger of the kind of imbalances. So again, there is structural root to this. So what I would argue is that there are 3 different reasons why the international monetary and financial system play a role here. Not only does it contribute to the formation of the imbalances, but it also failed to provide any effective mechanism to address the imbalances. So the first reason for this is because we don't have a true international reserve currency, and there is also the weak global financial safety net, which motivate countries to pursue accumulation of foreign reserves. So they want a growth, but they also want stable exchange rates and a balanced, if not surplus capital, current account. So they're able to accumulate reserves as a precautionary reason. And when critiques argue this amounts to the so-called beggar thy neighbor regime, right? So these countries are trying to export more than they import to accumulate reserves to keep the currency undervalued. I think countries would see this strategy as a defensive measure to balance economic growth and to achieve financial stability at the same time. In China specifically, capital account control is to stabilize financial flows, to shield itself from the kind of financial volatility, a very major reason that it learns through the Asian financial crisis in the late 90s. The second reason is I think the US dollar has been really the sort of the king dollar, right? As people would call it, right? It's a hegemonic currency. It's a dominant invoice payment currency. It means that countries wanted to accumulate dollar claims, right? They can invest a dollar, they can use the dollar to payments, and to facilitate their trade payments. So the demand for dollar and dollar assets allow the U.S. to finance the current account deficit by issuing its own dollar credits, which I think Oscar also mentioned earlier, right? It can simply create a credit against itself, which allow the rest of the world to net save. So in this case, I think it's this kind of unbalanced financial power gives rise to trade imbalance, which then in turn lead to macroeconomic imbalances. What I mean by this is that, say, a country like China, even if they have a desire to save, if the US does not import, if the US does not have the demand for Chinese exports, then China cannot net save, right? Even if they wanted to net save in dollar, but if the US simply does not have the demand for Chinese products, then China cannot net save. So this is basically Keynes's insight of the paradox of thrift. The more you want to save, the more you reduce your internal spending, the more you reduce your income, the more you are unable to save. So you have to have the kind of demand coming from the United States and other countries to allow China to be able to generate net savings. Okay, now there's an important insight here that some argues, well, look at the UK or look at other countries that they're not the reserve currency issuers, they are still running deficits for decades. So in other words, even if a country issues reserve currency, they could simply have a lot of assets that they acquire, so allow the rest of the world to have the dollars without running a trade deficit. That is correct. That is true. But the problem here is the United States does not provide sufficient dollar liquidity to the rest of the world through overseas asset acquisitions. So it does not, like China, for example, right, go out and invest in other countries or provide concessionally development finance like the BRI. So the US does not have the interest of overseas asset acquisition to provide dollar liquidity to the rest of the world or provide concession lending to the rest of the world. And instead, it runs larger amount of current account deficit. That's the way the US allow the rest of the world to have the dollars. And the third problem here is that I think as a deficit country, but also as a currency issuer country, reserve currency issuer country, the US is in a privileged position. It's not like other developing countries need to go through deflationary adjustments when they are running trade deficits. The US does not need to go through that. And the US does not experience a type of balance of payment crisis because the US has all the dollar it needs, right, to pay its debt. But there's a caveat, right? The US is a liquidity glut, right? The ability to issue dollar credits and its assets, excessive financial engineering, the so-called financial elasticity, it not only creates a condition for the rest of the world to save, but it also creates a very highly leveraged financial system that eventually produce the global financial crisis. So I think those 3 points are important to point out as we diagnose what's the root cause of global imbalances and what might be the consequences of the buildup of the imbalances, as well as what might be the solution, right, to this problem. So we need to look into the international monetary and financial system. Okay, so this is just quickly to present some sort of evidence of my claim earlier. So here is a chart about dollar hegemony. We know the US's GDP share is around 23%, trade share is only about 14%, but the dollar accounts for 64% as an invoice currency for trade, 58% for foreign exchange reserves, 57% for international bank claims, 63% for bonds, and 44% of foreign exchange turnovers. So this is rounding to 100, okay? So the dollar clearly has a overweight, right, in terms of its international role. And in terms of the US exorbitant privilege, so the top panel shows the US's net international investment position. It has been deteriorating since 2006 here and all the way to 2005. Here it shows the US's NIP, it's around 80% of its GDP. Okay, but despite this net liability position, the US's investment receipts on net is positive. So for example, when you look at the last data here, the US's net investment receipts, so what it received on its overseas assets minus what it paid on its international liability, it is about 0.6% of GDP. So US has so much debt, but it's still earning positive return on net. And I think that I also read, one of the report produced by your organization, right, that talked about official holdings of treasuries have gone down. The U.S. now has about 30% of its treasuries are held abroad. But that said, I think that we're seeing this interesting phenomenon where the foreign private holdings of the U.S. Treasury now exceeded the official holding. And this is since mid-2023. So what you're seeing here is you are still having over 9 trillion of these US treasuries are held abroad. And more than half of that is held by private investors, so represented by this red bars. Okay, so hedge funds, they're buying and selling a lot of these treasuries because they're providing high yield after the US Fed raised interest rate. And also because a lot of these stable coin and these cryptocurrencies, they're holding dollars for these cryptocurrency issuance because there's a one-to-one backup ratio that they need to meet. So we're seeing that the US Treasuries is still in very high demand. Okay, so I think that the US's privilege still continues. So I don't think there is a very quick unwinding of sort of dumping the US Treasuries. And the US, of course, still has this unrivaled financialization. It has the most in terms of the share when it comes to the stock of government bonds. So when you look at these black line here is the equity and bond market capitalization of the United States. And when you look at, the chart doesn't show very well. It's supposed to be dotted line for the government bonds. And the solid red line is the top one here is the Chinese equity and bond market capitalization. So you can see there's a huge distance. The US provides a lot more these financial assets for the rest of the world to invest in than China. Okay, so the bottom here, you can see the shares. The share of the global total government bonds, the US is over 45%. China is around 18%. And when you look at the equity and bond, the US is over 50%. China is less than 20%. So in other words, again, the US is a highly financialized economy. It provides a lot of dollar assets for the rest of the world to invest in. So I think that is what gives the US this sort of the so-called privilege, because countries have the intention to accumulate dollars and they have the ways to invest the dollars in the US dollar assets. Now, what are the risks of this current configuration? Well, for one, there is the financial risk. And this financial risk can be in many different forms. First of all, there are countries that are over-reliant on dollar financing. So they're vulnerable to US interest rate hikes or the exchange rate appreciation, right, which would make their debt burden much higher. But there's also the other side. There's the over-concentration of dollar-denominated reserve assets or assets in general. And so that also subject themselves to dollar depreciation risk. So an economy like Taiwan, when they have unhedged dollar assets in their pensions and their life insurance, when dollar depreciates, this then will wipe out their asset values. So that's another risk. But there's also the danger of over-reliance on the dollar-centric financial infrastructure. It both creates inefficiency, but also geopolitical weaponization risk when the US imposes sanctions, for instance. Okay. And finally, I think this idea that when the US have this exorbitant privilege, it allows itself to generate, current account deficit without adjustment, it continued to produce the kind of Triffin dilemma that the rest of the world relies on the US for liquidity, but the US liquidity is mostly, or the liquidity provision is mostly for domestic policy needs. They don't really care whether or not the rest of the world needs the liquidity, right? So I think that is a problem that is subject the rest of the world to the volatility or to the changes to the US monetary policies. And finally, I would argue right now, AI-driven financial instability is looming large, and the IMF and others have, sounded warnings. And I'll talk about this a little bit more. In addition to the financial risks, there are also trade and geopolitical risks. So protectionist policies are on the rise, and financial sanctions, as I mentioned earlier, that could also be a geopolitical risk. And finally, I wanted to just point out what might be the trigger. I don't think the advanced countries will run out their currency to pay for their debt because fortunately or unfortunately, their debt is denominated in their own currency. So they're not going to run out of the money. But I would say the kind of buy and sell private holding of the US treasuries are much more volatile than the official buy and hold kinds of measure. And so this could trigger a credit crunch. And second is going back to the AI story. I think the AI CapEx spending could drive up financing cost, and the rewinding of the investment could also be a major disruption. So why I don't worry too much about the US public debt to drive up the interest rate is if you look at the top panel here, the red line here is the US public debt. So as you see, it consistently increased. But you can also see the Fed funds rate or the 10-year Treasury notes, they don't change, so they're not going up consistently, right? So you have rising public debt over time, but what you see is the 10-year Treasury yield go up and down. So for example, it rose a lot in the 80s, partly because, again, the oil shock, price increases, expectation of inflation, and Fed raising interest rate, that increased the Treasury yield. And if you look at, for example, in 2020, there is an upward tick of the US public debt, right? Because all these COVID-related stimulus, but the Treasury yield actually went down. That's the black line here, right? And that's because the Fed has aggressively cut the interest rates. And so that reduced the 10-year Treasury yield as well. So I'm not too worried that the rising yield, the rising public debt will continue to drive up the interest rates. However, if the higher public debt leads to higher inflation, right? If more government spending leads to inflation and inflation expectation, so this is my lower chart, then this could increase the Fed funds rate. So this is, if you look at the very end of this chart, the black line shows a uptick of inflation, right? That's largely due to the Iran war and the oil price and so on and so forth. So when the oil price increases, when expectation of inflation also rise, this could lead the Fed to raise interest rates, right? And so that could raise the bond yields for 10-year treasuries and others. Okay, so there is a concern that these rising interest rates, the rising treasury yields could increase the US public debt. And that would continue to generate inflationary pressure. And also for the dollars, what we're seeing is that not only the dollar has depreciated over time, this is from the early January of 2025 to now, to later May 2025, what we're also seeing, more importantly, is the volatility of the exchange rates. So there is depreciation of the dollar coupled with volatility of the exchange rates. So I think that would create a lot of headaches, right, for the global South countries that rely on dollar financing. Okay. And the AI rewinding, I think, is a main, I think, risk. So if you look at the first to the left side of the chart, is that right now the US's IT-related investment is pretty much what drives the investment growth, because other investment and manufacturing investment are pretty much declining, right? It's less than the 100 as a benchmark. So what you see is that IT investment, especially to power the AI, is what drives the US economy, is what drives the stock market, not only in the US, but in Korea, in Taiwan, in many parts of the world. But I think AI boom is a risk factor. So I think I'm quickly running out of time, so I'm going to be brief on this. So I think the IMF has put out a report that they have a scenario where there is just a moderate correction in the AI stock valuation. This could reduce the global growth rate by zero point 0.4 percentage points. So when you think about the world growth rate is projected about 3% only, that 0.4% decline is significant. Okay. And I would say that financial condition tightening, right, because of inflation, because of this AI boom that drive up financing cost, all this could also reduce liquidity that's available for other users, and it raise financial cost, and it could induce capital outflows when the US's AI boom, slows down or even go into a bust. So why do I think there are these kinds of risks? For one is, even though right now the AI investment is largely financed by companies' earnings, but as the investment spending continues, as the IMF point out here, that financing is going to become more prevalent. So we are also seeing, for example, right now, a lot of the private credit is going into financing these AI startups and others. So that could a potential bit danger when you have a lot more debt financing going into the AI investment. There's also the great AI bifurcation. The hardware companies are doing fine, but the software companies are facing major risks. And finally, I think this is important, is the circular financing that we're witnessing. So in other words, all these tech giants, they're investing billions of dollars into the AI startups, and these AI startups then in turn spend their investment funds to buy hardware, or they lease data center from these exact investors. So you see the circular financing. So if one company, right, these startups, if they are not doing well, then you basically block the cash flows. So that could generate the kind of too connected to fail problem, right? That they're all investing in each other. So one company goes down, could bring down the rest. So that is a major concern. And the actual productive growth is yet to be seen. But companies are spending a lot in upgrading their AI models, and also in purchasing, their AI models. So there's really a question whether or not AI can continue to generate cash flows, right, for companies that heavily invest in AI. So I think that could be a potential, right, for this unwinding of this financial system, right, that it's now booming in terms of stock markets and so on. But I think the risk is still high. In terms of the trade risks, I think we don't need to say a lot about it because it's happening right now, that the US's effective tariff rate has gone up from 2.7% before 2024, before Trump, to now 18.8% on average as of October 2025. And different countries, Mexico, China, and India, and so on and so forth, they're facing very high tariffs, right? Brazil as well, okay? And not only is that the tariff is disrupting trade and economic production and global supply chain, but the kinds of ways that the tariffs were rolled out on and off, it also create a lot more policy uncertainty. So when you look at the incidence of policy uncertainty, this is an index developed by the IMF, and then you look at how it impacts on savings investment. So you can see how this uncertainty, right, has negative impacts on the rest of the world. So in terms of impact on saving, that's a negative 0.4% growth. And when it comes to investment, that's around 0.5% decline, right, due to this policy uncertainty. All right. I will just stress here, I think whatever happened in the United States or other advanced economies when this kind of financial rewinding. Okay, I would argue that the developing countries suffer the most. So this is basically showing you the economies that are at high risk of debt distress, right? As of 2025, there are 58 of these countries are already in high distress. In Latin America and Caribbean, there are 10 of them. So these countries will be the ones that suffer the most, right? When interest rate rises, when exchange rate appreciates, when exchange rate has these volatilities, and when trade is disrupted. All right. I only have less than a minute to go through China's counter strategy, so I'll be really brief on this. And if if there are any details, I can, maybe talk about this in the Q&A. So what China has been doing for one is diversifying. So its holding of the treasuries has gone down from 1.3 trillion at the peak in 2013 to now only $652 billion. So it's diversifying away from the US assets. And more importantly, it is promoting the RMB international uses. This is not to display the USD and become another hegemon currency, but really to provide optionalities for itself, but also for the rest of the world. So what China has been doing are five things at the multilateral level. One is to build the payment infrastructure, right? The Chinese International Payment Cross-Border Payment System, the CIPS. Second is it provides RMB financing, so providing development finance to the rest of the world, but in the RMB instead of dollar or euros. Third, provide the pathways for foreign investors to invest in the RMB assets. Fourth, to develop overseas offshore markets for RMB. And finally, provide liquidity backstops for countries. So the central bank has 43 swap lines with different monetary authorities. And so these could be used as emergency credit lines to help countries to cushion, right, their financial needs, the liquidity needs. Okay, so this is just, again, some evidence. The RMB share of China's cross-border payment now is over 50%. Again, the dollar has gone down from 50% to now around 20-ish%. Okay, and then China provides the yuan financing to its BRI lending. So this is the bottom line that shows the share of the RMB lending in BRI has gone up from around 10% or less than 10% back in the early 2010s to now over 50%. So China is trying to lend more and more in the yuan. And this is to allow the foreigners to hold Chinese RMB financial assets. So right now it's about 10 trillion yuan, which is about 3 times increase than back in 2016. But it's still tiny as a share of the total Chinese financial assets. Now, this is my second last slide, so I'll wrap up quickly. So at the regional level, China is connecting to the rest of the world when it comes to the payment system, especially with the Asian economies. And China is part of the Qingmai, which is, again, regional financial safety net. And China co-leads BRICS and its agenda to build alternative international monetary and financial system. And finally, China is the initiator and the major contributor to the Asian Infrastructure Investment Bank, and now have 57 members. So my conclusion, I'm just going to leave the slides here briefly, are 5 of these, I think, important points, right? So one, I think that global imbalances is a symptom of a flawed international monetary financial system. It's not just distortive national policies. And second, dollar hegemony generates systematic risks for both surplus and deficit countries, and global South countries bear the major brunt of this. Third, the Chinese RMB strategy is a defensive diversification. It's not a hegemonic displacement of the dollar. And fourth, I think a multipolar monetary system is most likely to be a near-term trajectory. And finally, I think a durable resolution to global imbalances requires a multilateral international monetary and financial system reform. And so there are tremendous implications for how global South countries should act accordingly. So I will stop here. Sorry for running out of time. I think I probably are in deficit. Thank you.
Well, we're gonna continue now with Ariella, but first, I'm taking from the conclusions regarding China. I mean, we could talk about this for days, but really the financial component and how, in the end, the recommendation in the conclusions is very important. This this webinar is going to be sent. So those writing, just so you know, and so we are going to let Ariela Ruiz, our last panelist, come in. So Ariela, thank you again. I would like you to, well, once Dr. Ugarteche and Jan already gave us the context regarding the global imbalances regarding the US and China. Maybe you can help us go deeper into and land a little bit more into the impacts for Latin America and the Caribbean in terms of the dependency, the structural dependency that we have regarding the dollar, how it affects our international reserves, the restrictions in economic policy, and what risks what do we face in Latin America and the Caribbean to keep a significant part of our international reserves in dollars. Um, Tell us about the loss of trust in the treasury bonds that we're seeing currently, and how the rates of the bonds in 10 years are starting to move. And what else do you see in the region countries to diversify the reserves, and how we can reduce these financial shocks Jan was talking about coming from the north? So go ahead, Arila. Thank you. Thank you. Thank you, Jorge. Thank you, Latundad. And I want to greet my colleagues, Oscar and Jan. Well, after having heard these very interesting talks, I was thinking about talking about or bringing some phrases from the U.S. politician Robert Gilhart, and he said something that I want to share with you. And it says, the U.S. hegemony is sustained on four pillars: their army, their raw materials, the control of technology, and above all, the role of the dollar as the global currency. When the guns fail, such as the difficulties that we see now, or we have seen in Vietnam, or in the Middle East now, the real panic button in the White House is the control of the global financial system. So I think that with this framework, I'm going to start responding as much as I can what you proposed. So yeah, definitely in Latin America, the dollar, both in a bill and in treasury bonds in the US that are issued by the Treasury in the US, dominate as the asset of international reserves in our central banks, and it exceeds 60%. The rest of assets are conformed by other currencies such as euro, yen, yuan, um, and gold and other things. Because we're also sensitives, even though we do have an alignment in the region regarding the relationship with the US right now, there has been an increase of the gold assets. There's been purchases in gold, and some countries, such as Brazil, have even dared to leave the treasury bonds since there's a lack of trust that is very well based, which we have heard about now. I'm not going to go deeper into that, but it has come from that. So why did we always choose treasury bonds as the main reserve asset? Well, there's certainty they were backed by the United States government, which would minimize the risk of lack of payment, which is not today, as we have heard in the other presentations. The liquidity, because anybody can go and sell a treasury bond and it's going to be bought. That is a very, uh, it has a financial depth, this asset, that other assets do not have yet. And it offers a profitability that is moderate but safe. So, and why did we choose them? Because we do have an important turnover in our trade in dollars. All of our raw materials are quoted in dollars because we measure, we quote the copper, the lithium, and all raw materials in dollars, everything we sell. It is also a exchange leverage. Our currencies fluctuate with the dollar, and our currency is fixed in dollars. But the international model imposes in Latin America the urgent need to reevaluate the architecture of our international reserves, because um, this contemporary context, this structural dependency exposes the region in to critical vulnerabilities that erode their macroeconomic stability. So first, these vulnerabilities are manifested in the illusion of value due to the elevated interest rates that the US government has to pay in order to make them attractive. So we have acquired treasury bonds with a ROI of 2 or 3%. If we needed to sell those bonds because they have high liquidity for whatever reason, it's going to generate a loss because nobody is going to buy treasury bonds issued at 2 or 3% yield at that price when right now they exceed 5%. At least right now, the bonds issued at 30 years or even 10 years. So there is a loss there. Our equity has been devaluated. Our equity in the central reserve banks, due to having so many assets in US Treasury bonds or in dollars. In dollars, have it be in bills, but mostly is in Treasury bonds that are also in they're paper, right? We cannot have so many accumulated bills. Now, regarding that accounting weakness, we have an external transmission channel that is very detrimental for our local economies, which is the effect of the potential devaluation and the high cost of credit. So the big investment funds, they take their capital away from Latin America when they see these funds to look for a higher profitability in the north. That is supposed to be safer, supposed to be. This outflow of capital can generate a scarcity in currency in the region that may devaluate the local currencies. So the Latin American central banks have to elevate their own local interest rates in order to face that capital outflow. Other important aspect is the import of the US inflation. When the US Federal Reserve increases their interest rates in order to contain their own internal inflation, we import their inflation. That has an impact that stops the growth in the economies in the region because our central bank is going to be increasing credit rates, interest rates. There's the corporate credit's going to get cooled. Interest rates are very high for SMEs, and that generates over 60% of employment in Latin America. So there's a loss in employment. There's a very high impact in the region. Then there's a parallelization of investment in infrastructure. So the sectors that demand more intensive labor, they depend on long-term financing, and that is increased. So there obviously this is going to bring as a consequence a mediocre economical growth. The World Bank, the IMF are already anticipating that. I'm going to try not to talk about numbers, but it's quite lower. 2.1 to 2.3%, much lower than what we've seen before. I already gave a number. But also the increase of work informality, loss of workforce. Um, so to this risk, say financial risk, we can add a geopolitical risk of the first order, which is the use of the dollar as a weapon for coercion or the weaponization of the dollar, right? So we've seen that recently, not in a region, but with Russia, when $300,000 million were frozen in the reserve and that was pushed out, they were thrown out of the SWIFT. So, and that affected people, right? They could not buy anything, like a booking of a plane ticket, a hotel, any purchase. They could not use the SWIFT system. And that motivated Russia in alliance with China and all of the countries that are susceptible to financial sanctions to try to create mechanisms such as the Enrich and others, that's for a different debate, to be able to trade with other countries, since most of the debt securities in the region are guarded in the Fed in New York or government institutions, the U.S. has an extraterritorial power on our equ equity, exposing the countries to be, or say, so if the other countries do not align to Washington policy, they may have secondary sanctions. And we are seeing that increasingly as it is defined in the national strategy of and safety in the U.S. A recent case that wasn't with the U.S. but with the Western system. Let's remind us when Venezuela in 2019 he had 31 tons of gold from their international reserves were held that were located in the UK bank. Why? Because I don't like your government or whatever, whatever. So beyond the the values or whatever you may think of the Venezuelan government, the reserves are sovereign. There's a sovereign equity of the country, and no country can hold another country's reserves. Now, what room to maneuver is there for the countries to diversify the reserves? It's not as easy or to strengthen regional mechanisms to reduce the external shocks. I think that this is very important. So you may say that Washington doesn't even need to call a director of the central bank, but the system is designed in this way. If a central bank of a Latin American country or from another region tries to massively sell their treasury bonds from the US, for example, the international financial system is gonna make their debt more expensive. Why? Because the credit scoring agencies are gonna give them a bad score, right? So we're gonna have issues there. So when a central bank in Latin America reduces drastically their assets in dollars or treasury securities to migrate to less liquid assets such as gold, for example, or different alternatives such as, for example, digital yuan swaps with China, the credit scoring agencies, they're going to give us a bad score. Um, so what alternatives do we have? Well, the ones that have the most probabilities of proposing alternative mechanisms are the countries that have a strong commerce or trade with Asia. And the countries in Latin America that have more trade with Asia are Brazil, Peru, and Chile. And actually, the central bank in Brazil, which is the country that has more international reserves in the region, around $360 billion dollars, has had a strong or still having a strong reliably on dollars. 62% of the reserves right now are in dollars, but it used to be more. 2 years ago, they have an aggressive, I would say, strategy of diversification geographically and geopolitically because they have acquired gold. They are some of the countries in the region that have acquired the most gold. They have let go of treasury bonds of the US, and they have entered into swaps with China. That means that 40% swap is an exchange of currency. Okay, so in simple terms. So when Brazil or China provides yuans and Brazil provides reais. So when China wants to buy something from Brazil, whatever, China uses those reais from that agreement and the other way around. And that has generated that 40% of the trade exchange between those two countries is happening in local currencies. That is what that means. On the other hand, and it's not very much talked about, the Peruvian Central Bank has entered into an agreement of I'm gonna I'm gonna mention this in a little bit, but Peru and Chile having a much more important trade in relative terms than Brazil cannot use the swaps in local currency because here it's not just an issue of ideology, but of convenience of the companies that are trading. So beyond the characteristics of a government, the companies, they think about their own costs. So it's not that they're going to listen to the pressures of the US automatically, because otherwise we wouldn't have built the Chancay port, which is the US biggest headache right now in the region, in the struggle for controlling trade and investment and infrastructure and the financial channels. So, well, Peru and Chile, why is it that they're not able to do it? The thing is that copper, which is that they export the most to China, the agreements, and Chile lithium as well. Those agreements are quoted mandatorily in dollars under the standards of the UK metal stock. So, so the change is going to be harder here compared to the export characteristics in Brazil. So anyway, and here I'm going to back to what I was saying before. The mechanisms that are being used by Brazil and also Peru. In Peru, it's still being studied, but the PIX, which was created in 2020, is an instantaneous payment system and of e-transfers that are functioning from the central bank in Brazil. So in Peru, we have mechanisms such as Yape and Plin, but they are connected to bank accounts in private banks. So the intermediation is being done through Visa and MasterCard. So you pay the bus with Yape. You can buy a avocado with your Yape or your Plin in your phone. But in Brazil, this is a government mechanism. And since it is a government mechanism, Trump imposed to Brazil, and that was one of the reasons the trial to Bolsonaro, Trump wasn't in agreement with having his friend Bolsonaro go into a trial, be trialed. And they didn't agree either with having a mechanism such as PIX from the central bank. Why? Because it was excluding Visa and MasterCard, or Google Pay, or Apple Pay, right? So they do not allow that. But Brazil, um, they kept a very strong position, and they did not let them and the population back them because PIX has reached the lower income sectors because there's no interest. You don't have to have a bank account anywhere to have this possibility of paying or having an electronic wallet. And in Peru, 2024, under the government of Dina Boluarte, and with the president of the central bank, who's a very smart person, they entered into an agreement with India to an agreement that is for Peru to have a system just like the one in Brazil and also like the one in India. The mechanism in Peru is called Automatic Transfer Payments Peru, TAMP, which is a public digital infrastructure that is handled from the central bank. That is still undergoing process. Um, they're establishing still yet. It's not working, but it is going to work. And that is also going to be a hit for MasterCard. And we're going to get pressure, just like we had pressure due to the Chancay port and so on. And then what other measures can we take in order to reduce that dependency? I would say to strengthen regional mechanisms of liquidity, such as the Latin American Fund of Reserve. that has been left behind a little bit. And well, not stay away or side eye when we're talking about alternatives in terms of technology such as Embrit that is not of the BRICS, even though they have adopted it. Embrit is an initiative from the International Bank of Payments of Basilea that the Monetary Fund ordered to suspend because it's taking the power away from the US. But, well, that is why I think it's so important, this event that you have brought together, Jorge, because you have to be looking at these phenomena that seem to be far away, but they do have a direct effect on the life of the countries. And well, another pathway to reduce the dependency on the dollar is having inter-sub-regional trade in local currencies, at least as it was in the 80s in the framework of the agreement of credits and reciprocal credits and payments. What was that? Back in the debt crisis decade, the countries didn't have dollars. So there was a conversation chamber for payments and credits that was established that would be paid uh, every 4 months, and the agent handling that was the central bank in Peru. But the balance was paid in dollars. Now the countries are proposing not just the BRICS, but ASEAN, the associations of countries in Southeast Asia, the African Union, the Cooperation of the Gulf. All of these original mechanisms are proposing this kind of mechanism and the balance to have it be paid in some kind of currency basket, sub-regional currency basket, with guarantee in some raw material, gold probably, or oil. But the whole world is trying to reduce in these ways their dependency on using the dollar. But what happens with Latin America? Latin America is the only region that is not exploiting this use of at least uh, taking the dollar out of the neighborhood trade, and is not doing that with China either. But I think that the megaport in Shanghai is going to provide the possibilities of, in as much as, well, it is a hub port, well, the payments that are going to be made um, for the exports or imports that are being undertaken to or that are sent to neighbor countries are going to generate payment needs. So why go through the SWIFT, which is a very costly mechanism because you have to exchange your currency into dollars and from dollars to the other currency, and every step has a commission. So that is overall. I don't want to talk too much about this so that we can have a chance to have a Q&A and so on. But I think that just to conclude, maintaining our international reserves tied mostly to the dollar or to treasury securities does not represent anymore that safe haven that used to exist. Life changes. Nowadays, it involves absorbing the volatility of interest rates in the Fed, the erosion inflationary erosion of the US. Inflation is very high due to the war, absurd war, of which the US president is not finding a way to get out of. And it's a geopolitical risk increasingly, because if we do not obey exactly to the guidelines of the foreign policy in the US, it's not just, as I already told you, according to my perception, of course, that the system itself punishes you. But furthermore, there's political decisions that may freeze assets And facing that, the room to maneuver in Latin America to diversify their reserves is not going to be coming from decisions or political proposals. I don't think that is going to go through that route. But as I said before, from the corporate interest of spending less. And that is the example of the Chancay port. There was 40% of that port was a proven investment, right? Of a proven company. And I think that they really lobbied the government. And thanks to that interest, or, we can say thanks to that, or due to that interest, really. I don't want to say what I think about it, but although I do agree with the possibilities that are being brought by the port, but the management cannot be left uh, freely. It has to have a government orientation. The government has to orient investment and propose projects to leverage this for the country. It cannot be left to the market completely. So anyway, so the room of maneuver for Latin America to diversify the reserves are not going to be coming from there, as I said. Brazil is starting to use practicality and is undertaking the trade with China, as I said, in local currency, have their trade, and the and I think that there is a feasibility in using digital platforms. I do believe that. And the reality is that the countries in the periphery are not necessarily looking to defy Washington for a political alignment, but just for a economy survival. And in this financial order, or contested financial order, the real sovereignty is not going to be about choosing a geopolitical band, but having the technical and financial freedom to choose the currency and the logistic route that is going to define the best course for the nations. Thank you. Thank you, Ariela. Mm, Very complete presentation. And before I continue, I want to tell you that we have a report that was made by Ariela. It has been published in our website. It's in Spanish and English. In a few moments, we're going to share the link here in the chat. Now, given I think that, well, it's been a while that we don't have such a panel that is loaded with so many things to talk about. We could be here for hours or days, very complete. So I see that I have some questions in the chat, but as you were talking, you were resolving most of the questions. So since we don't have a lot of time, I would like to open the table for final conclusions of each one of the panelists. Um, so that maybe in the future we can get together again in another webinar. We would love to continue talking about this. So just not to take more of your time, I'm gonna continue in the same order. So Dr. Orteche, then Jan, and then Ariela for the final conclusions in 3 minutes. Go ahead. You're muted. Sorry. So a graph that was showed by Jan about the sector investments in the US shows how the investments in IT are the investments that are being led in the investment sector, right? So the investments within the US are led by investments in IT. However, as we have seen, they do not have patents. They are not getting any patents, and their IT trade is loaded towards imports that are coming from Asia, Korea, Japan, and China. Not to mention, because they're not in the list, but we can also bring Malaysia and other countries. So in the real side, there's a very big imbalance between what is being invested in IT within the US and how that is translated into the external deficit with Asia. I think that that is something that has been left or very clear, at least for me. Something that is also very clear that is quite scary is this, that Jan actually showed it such a brutally real way that it reminded me of the 80s. Is growth of the assets in dollars exponentially. They grow and grow and grow. And then the system collapses, right? What happened in the US in the Vulcan plan. So the system collapses, the interest rate goes up. When it goes up, the prices of raw materials collapse. And the US exports their crisis. It was exported to us in Africa, in Central Europe, in a great part of Asia, and to us. So everybody who was in debt ended up um, buried. Whose responsibility was it? The US problem. The diagnosis, however, for Latin America, because each region had their own diagnosis, is that the issue in Latin America was the industrialization. Why? Well, because we cannot have industry in Latin America, so therefore, um, yeah, market affected us. Now this time, it is much worse because you have the US that is over in debt. You have an US economy that is growing a lot less progressively, and an asset value that is over-dimensioned immensely. So the increase in the interest rate is going to be poked. Yeah. If you poke the commodity market, which is denominated in dollars, and you bring down all of the emerging economies, first you're going to bring down those that are the lowest, the ones that Jan showed in the Africa chart, and it's basically Africa, right? And I think some countries in the Indic Ocean, but you're going to bring everybody down. The US, like Susan Strange mentioned in her work in 71, they have the capacity of exporting crisis. And they're not going to hesitate in exporting their crisis. Now, when we in 2008 we decided to create the Bank of the South with this financial architecture in the South to be protected of the crisis that didn't just reach us, but it shaked us or shake the whole world. In Latin America, the reaction wasn't, okay, let's do this. It wasn't the European action. It wasn't the European reaction of 72 when the 72 crisis of the dollar. Then the Europeans got together. They established an exchange system with a band, and they created the European financial institutions in local European currencies. However, and here I'm going to speak as myself, when I proposed to do something like that, and we had these first conversations between presidents to convert this. By the way, presidents create ICEA, which is Lula, Chavez, and Rafael Correa. The reaction in the other countries was that was Castro terrorism. So I wonder, in Latin America, the ideological component of those making this economical decisions. Because, yeah, definitely the payment mechanisms are decided by buyers. Yeah, sure. So the companies are defining how things are being paid. Sure. However, the governments are the ones that can define the architecture within which those big payments happen and the mechanisms through which you can win win out from that third currency. Well, in Win, it doesn't exist anymore, but we have it hang in the portal of our observatory, but we removed it. That index served to see if we would maintain the value between the currencies. And where we found with daily data for 22 countries throughout 10 years, that did not include Argentina or Venezuela. So it wasn't 22, it was 20 actually. What we found it was that it was stable. So you could go from one currency to the other using the index as a reference unit, save everything that you have to that you can save in commissions, and in our calculation it was 6.5%. But I understand that there's newer calculations that make it a lot higher because the exchange spread has increased. So it's not 6.5, but I don't know, much higher. So it is possible. There are mechanisms within the ASEAN. They are developing mechanisms. And when we did that in 2008, in the Treaty of Chiang Mai, that was already signed, and there were mechanisms being developed. Scholars came from Japan to these institutions, but the official reaction of the governments in Latin America was, I found it quite particular, and the position in the press. This is Castro Chavism and this and that. And for me, honestly, it happened to me in Lima with somebody I knew. I got bored. I said, okay, pack yourselves. We're trying to stop this from happening to us. I mean, we cannot stop it if we don't do anything, that we just stay here and take it. I promise that we will take it. But if the level of ideologism is such that any autonomy mechanism is considered subversive, well, first we're talking about a delayed teenage years because we are a republic that has over 2,000 years, so we are not teenage countries. And on the other side, we're talking about an elite that is delayed, an intellectual elite that is completely delayed and misinformed, that don't really know what the European process was or the Asian process was. So I'm concerned about the change process because we do need, definitely need to redesign the international financial system. However, well, let's see. You mentioned in Mexico the word redesign international system to see where you get. It's not possible because you don't understand that 40 million Mexican people are living in the US and the dependency that we have, that 80% of the trade. Yeah, but we're not talking about that. We have an issue here of not being concerned by the crisis. I'm sorry, there is an issue about not importing crisis, not having what happened in 81 happen again, and apparently it is going to happen. So, yeah, it is going to happen. It is going to happen. If the Fed increases the interest rate, we're going to do the same. Our growth rate is going to go down. The prices of raw materials are going to go to hell. And that's going to be it with very low growths. The ones closer to China are going to have a lesser impact. Those further away from China are going to be very much impacted. Mexico, Central America, they are basically not growing at all. And the interest rate hasn't even increased yet. So that is the situation. So we do need a change in the architecture. And you know what we need to have the West? But this is always the worst, right? To give up power, give up the status. That is horrible, right? I mean, it costed Marie Antoinette their head. Louis XVI lost his head. So it's hard to stop being king or queen. We have those that would rather die than stop being queen or king. So thank you so much, and I apologize for interrupting. And these are very powerful positions, and so that we can let the others speak as well.
So I will first quickly address the two questions in the Q&A, and then I will have a very brief conclusion. I already overused my time. So first of all, I think there was a question about gold price. I think that it's exactly, the way the countries try to diversify away from the US treasuries as their foreign exchange reserves is, I think, part of the reason that drove up the gold price. I think a study by the ECB by the end of 2025, they show that the gold reserves now account for 27% of the total official reserves, compared to the US Treasury was down to about 22%. So countries actually have more gold for the reserves than the US Treasuries. But of course, there are limitations because gold price could also be volatile, and we have seen this kinds of up and downs in the early 2026. So that's why I think the diversification of reserves is one strategy, but it's only one of them. There need to be multiple strategies. So I really appreciate what Arila was talking about. Regional, we need to build up this kind of regional reserve funds, right? The Chiang Mai or Gulf states or Africa BRICS. We need more of these kinds of regional financial safety net. And the second point that I wanted to make in terms of the cross-border payments, there was a question about whether or not it's monitored on an annual basis. I have not seen a lot of the statistics, but I think one thing that JP Morgan put out is that right now the global annual cross-border wholesale payments was around $24 trillion. And so that costs countries $120 billion a year. So it is rather costly and inefficient because it does take 2 to 3 days for some of the transactions to clear, and it's also opaque. And you also rely on the U.S. correspondent banks, you rely on the SWIFT. So again, there is a chance that you get cut off. And I think UNTAD also put out a report that the correspondent banks number has been declining, and that really hurt many countries when it comes to trade because the payments are hard to go through. I have written some papers on the South Corporation on cross-border payment structure and some other financial matters, and I'm happy to share. So my last sort of conclusion, I think I pretty much agree with both Oscar in terms of this is really a more of a geopolitical question, right? Whether or not countries themselves build the trust, right? Even within BRICS, I think you see Russia and China are pretty much in sync and about developing this alternative payment system. I think India's on board, Brazil's on board, and so on and so forth. But there's still a lot of institutional details need to work out, right? Can countries all come up with the same for example, data privacy protection rules that they would be happy about? How do they solve disputes when it comes to payment problems, and how do we provide liquidity, right? Collectively. So there's a lot of geopolitical questions, not to mention, I think Donald Trump has warned or threatened 100% tariffs, right? When countries move away from the dollar orbit. But I think, Arila also, really articulated very well. It's not a choice. We have to do this, right? Because the current system is inefficient, unsafe, unjust, and, high risk, and you name it. So I think it also is a structural barrier for countries to really pursue, right, their full employment and autonomous policies. So I think a lot is at stake. I do think that countries have to act, but collectively, that's the only way you can resist, right, the kind of pressure coming from Washington and Brussels and elsewhere. So I think China can play a key role. I know that there's a lot of I think maybe reasonable, right, skepticism because China is huge, China is competitive. But I think at least when it comes to building alternative financial architecture, I think the global South countries really need to act together because that is really essential, for their future prospect. So I'll just end here.
Thank you so much, Ian, and thank you so much for giving a direct answer to the questions that we had in the chat. And we're going to finish with Ariela. Your turn. Thank you so much. You're muted.
Yep. Yep.
Sorry, I was muted. Well, honestly, it's not a lot what I need to add. I do share the conclusions from my colleagues. Um, I think that maybe I wasn't well understood when I said that the decisions of using these mechanisms, for example, the swaps with China, are going to be determined by the corporations that are going to be reducing costs with that more than by a political decision. I think that it is that way, but also obviously the government has to take care of generating these mechanisms and not be scared when the BRICS propose certain mechanisms to get rid of the dollar influence. Because here, I think that the BRICS, they just say they gather the feeling of countries that are in the political antipodes, but there is a position that brings them together, which is the need to strengthen the institutions of governments globally, both political and economic. So I think that it's actually the US who was the designer of these structures. The Safety Council of the United Nations and all of the agencies in the United States and the institutions of Bretton Woods and the IMF and the World Bank. Today, they are the one bearing, not just because they abandon them, but they don't allow to change them in a way. And also the mechanism is designed so that it cannot be reformulated and make them more representative and democratic. So I think that Latin America is scared of the BRICS. They're scared of um, launching minimal initiatives such as regional trade in local currencies, exploring mechanisms. Like Oscar mentioned in 2008, it was surprising that governments such as Kirchner's, Lula, they were opposed to the mechanisms that now the BRICS are bringing together, such as installing the currency of Sucre and other mechanisms. So the argument was that um, the uh, Promotion and Andean Corporation and the Latin American Reserve Fund, yeah, they exist. They were saying they exist. Yeah, these mechanisms are working under US guidelines. That is the truth. So what was being proposed was to create more independent mechanisms that they didn't understand, and that was left behind. We need to bring it back, but this is a long journey because right now with the initiatives of the America's Shield, where the US has not only a political influence in elections in in Latin America, but also in legal processes. The truth is, it's hard. Uh, Intromission, limitless influence. It's a government that is very army oriented. So having kidnapped the president in Venezuela, like it or not, it's inadmissible. And Latin America has been able to say something about it. We were not able to get a consensus in something as basic as not being able to invade, kill 100 people, and kidnap a president, like it or not. So there is a big challenge. There's a long journey. And I think that events such as this ones are very important because we don't really know. We have to bring these topics to the table because they do affect us and they determine politics. Even more than the measures that may be taken by us ourselves. We are nobody, no country in Latin America by themselves is going to do anything. It's the decisions that are made in the international arena that are going to determine our development and our economy. So we have to try to lower that to this level and try to work together in this common denominators, minimum common denominators in the region. Thank you. Thank you so much, Arila, for your conclusions. And thank you, everybody. I want to say it again. This has been quite a good webinar in terms of content, quite powerful. We are going to send the recording. And again, we want to invite you to future webinars and to read Ariela's document, which is in our website. And again, I want to thank you for assisting. Thank you so much, Ariela, Dr. Ugarteche, Yang. And so we're going to stop it here and hope to see you again.